Hey guys, welcome back. I'm Vishwa and this is our technical analysis course bundle. And here I am back at teaching you how to use the technical analysis and how to use the candlestick charts to profit from the stock market. In our previous video, we saw about the basics of candlestick chart. We've covered all the interesting stuff about the different candle patterns and how to use them to identify the market direction. From this video on, we're going to get a little bit more specific on the entry points. Now, this is important. Well, say you want to buy a stock. First of all, you have to know where to buy it. That is, you have to know that the stock is not already too expensive to buy. Also, you have to know the fair price or the price range at which you can buy the stock to minimize on the risk. In technical analysis, we use probability as an indicator to decide on this fair price. When your stock has a higher probability to go up in the coming days, then you're only paying a fair price for it now, so that you can make profits later on by selling it at a higher price. Now, to do this efficiently with a minimized risk, you have to understand the technical probability of a stock moving in a favorable direction. For this, we employ some logic, some strategies, and some tactics to know whether the stock would go up or down in the future. So, from this video on, we're going to talk about initiating a real trade position. In other words, you're going to learn where to buy or sell a stock using technical analysis. So let's get started. For our first video, we're going to talk about one of my personal favorite candle patterns, the hammer. We call it hammer because it looks like a hammer. It's that simple. And every single candle pattern has different names. But you don't really have to remember these names. Rather, all you have to do is understand the logic and concept behind each of these candle patterns. And that's exactly what we're going to do here in this video series. So, let's start with the very basic. Let me tell you how to identify a hammer candle pattern. It's pretty simple. A hammer has a small real body and a long lower shadow. So, whenever you find a candle pattern that has a small real body and a long lower shadow, like you see here on the screen, you can immediately know that it's a hammer candle pattern. But that's not all. We have some rules to identify the hammer that really works. We're going to cover that in the coming slides. But for now, just know that the hammer has a small real body and a long lower shadow. And just to give you a taste of it, I'm going to show you a little animation on how a hammer is formed, so that it'll be easier for you to understand the logic behind it. So, the market opens somewhere around 20 level in this example, and what happens is that the sellers are very active in pushing the prices down, and the price comes down to 10 bucks. Now, at this level, the buyers got really strong, and somehow they managed to take the price back to 20 level. What this means is that the buyers were so strong that they were able to overcome all the selling pressure that initially pushed the price down. So, the hammer candle pattern tells you about the strength of the buyers during that specific session. Now, when you see a hammer candle pattern, you don't just see a small real body and a long lower shadow anymore, but rather you know about the strength of the buying pressure that is built on this hammer candle pattern. And this hammer pattern, if it occurs at a strong supple level, a sweet spot, then you have a high probability trade setup. You can immediately buy after this hammer is formed. Now, let's see how to increase your success rate trading hammer. We saw that the technical analysis is all about finding a high probability trade setup. And to increase the probability of a hammer pattern, you're going to incorporate some rules to filter out a high probability hammer trade setup. So, the first rule is that the hammer must be made up of a small real body, and this real body can be of any color. In other words, a hammer can have a bullish small real body or a bearish small real body. It doesn't really matter. Moving on, the lower shadow must be twice the length of the small real body, meaning you should be able to fit two of these real bodies inside the shadows. This is a very important rule because the lower shadow tells you about the strength of the bias in the hammer. So it must be twice the length of the real body. Coming to the upper shadow, when there is no upper shadow, it's really very good. But a hammer can have a slight upper shadow. It can be up to 30% of this entire hammer range. However, if the upper shadow is more than 30% of the entire range, then the hammer is an invalid one. You don't trade that, full stop. Now, to put things into perspective, I have added some examples of what we just learned. So let's just check it. For our first example, we have a hammer right here at 128 level, from where the price moved up strongly. In the same example, we have two more hammer patterns over here and here. Out of these three candle patterns, we'll only be trading one, the one at the 128 level. We'll see why in a moment. But before that, we'll see another example. In here, we have a couple of hammer at 1970 level, after which the price had strongly reversed. We also have a third hammer in this example right over here, from where the price did not go up. Now, as you can see, finding a hammer pattern on a chart is really easy. Of course, the hammer is a recurring candle pattern, but can you differentiate between the hammer that works from the hammer that does not work? Well, you can, and it's really easy. We saw that the hammer pattern reverses any selling pressure. What this means is that the buyers are taking advantage of the lower prices and begins to initiate their new long positions on a stock. So, the ideal condition to trade a hammer is after a price decline. Meaning, when you buy on a hammer candle pattern, you must make sure that the hammer is formed after a downtrend. This is very important because the hammer is a downtrend reversal pattern, and when you see a hammer after an uptrend, you don't really trade that hammer because it has a very less chance of succeeding. So let's go back to our examples. As you can see here, these two candle patterns are formed after a downtrend, and see how the price is reversed strongly after this hammer pattern. But the same thing did not happen with this hammer at 2020 level because you don't have a prior downtrend. Moving on to the next example, this hammer right over here is formed after a downtrend, so you can use this hammer to buy a stock. But the other two hammers that you see over here are not really an ideal setup for you to initiate a long position, because these type of hammer trade setups have a very low success rate, which you obviously do not want to trade. And for the last example, once again you have a same setup, a hammer after a downtrend, after which the price had strongly reversed. And this is exactly what you want to see when you're trading, the price moving strongly in your favor, and the hammer candle pattern can help you achieve that. And these are the different types of hammer pattern that you would come across when you're trading the real markets. And not all of these hammer patterns are equal in strength, and not all of these hammers have the same probability of success rate. I cover all these things in detail in my advanced course, but for now just understand that these are the different varieties of hammer candle pattern that you would come across in your daily trading. So that's pretty much it for the basics of how you use a hammer candle pattern in your own trading. I'll see you in the next video with another interesting candle pattern. Until then, have fun trading the hammer pattern. Thanks for watching. Bye bye.